Business Incorporated today. Kenya Electricity Generating Company expects a windfall from a planned sale of 287,416 certified emission reduction credits. And a 58% increase in maize harvest is expected in Zimbabwe. East African Community Secretariat commences the process of digitizing its common external tariffs. Good afternoon. Welcome to another episode of Business Incorporated here on Channels Television. I'm Ini John Mekwa. We head straight off to the market, and it's a good one for the NGX, sustaining that bullish sentiment from yesterday at intraday. We see the number is up there, 0.16%. South Africa is on the flip side, is on 0.15%. But of course, they still have that 78,000 they've been keeping for a couple of weeks now. We see other parts of the continent. In Egypt, it's red, even though it's closed, 0.13%. Kenya is also closed, but closed in the red, 0.54%. We move to the Middle East now, where we see that it's mostly negative. Abu Dhabi is negative 0.04%. Dubai, negative 1.16%. Saudi Arabia remains closed for a second trading day, but it closed positive 1.19%. Qatar is, however, negative 0.11%. Let's go to Europe now and see what's happening there. We know that there is a car show going on in Europe. We have Cassandra Escons now joining us to tell us the details of that. Hi, Cassandra. What can you tell us about that auto show that's going on in Germany?
Thanks for having me. Yeah, it's really large, both in terms of people, power, and attendance, and the kind of splashy headlines the companies are hoping to make at the event. Now, the entire board of Volkswagen AG and more than 100 VW employees are in attendance. That's noticeable, especially when compared to the presence of French and Japanese companies. Meanwhile, BMW is looking to make a strong showing with 3 world premieres at the week-long event, and Mercedes-Benz was trying to lead the pack by debuting the luxury car maker's latest all-electric SUV before the fair even officially opened. And that's because German companies realize that China is a massive market, and that's only going to be increasingly important to their international business models. Even now, German companies are relying on China for a third of their passenger vehicle sales, so there's a lot to lose.
I guess that's why we see the German companies afraid and doubling down.
Yeah, I get the impression that German car makers are trying to make up for lost time when it comes to the electric vehicle market in China. During the combustion engine era, German car makers were known as the pinnacle of global auto engineering. And this was also true in China. But as automotive trends have gone more and more electric, Germany isn't leading the pack anymore. They're in fact learning from their Chinese counterparts who have moved faster on developing technology for EVs. And that's what's setting those companies apart, those Chinese companies. Let's just look at some of these figures. While the combined market share of the battery electric vehicle market in China, held by 4 big German companies, Audi, BMW, Volkswagen, and Mercedes-Benz, that share more than doubled between 2020 and 2022. But that latest figure was still only 4.8% of the market. And taking a look at German car makers' total market share in China, that rose from about 20% in 2015 up to 24.6% in 2019. But since then, it has taken a tumble, and the latest figure looking at about 19.1%. So this could all be signaling that the Chinese market is no longer as stable for German car makers as it once was.
Yeah, so I wonder how this is affecting the stocks on the market.
Europe's top stock market slid on Thursday's opening as fears persist around elevated inflation. London's benchmark FTSE 100 index of the leading blue chip companies, it dipped 0.1%. Taking a look at the Eurozone, the Paris CAC 40 index also fell by 0.1%, and the Frankfurt DAX shed 0.3%. In addition to that stubbornly high inflation, especially out of the UK, there are worries right now about future central central bank moves to tame those high consumer prices. Because what's the main tool to do just that at the moment? That would be rate hikes.
All right, Cassandra, thank you so much for giving us up to date on that and a whole lot more. Well, let's talking about the London market you mentioned there. Let's head to the UK, and it's good to have Juliana back. Juliana, good to see you back. Tenny was trying hard to stand in there, but it's good to have you back, Juliana.
It's nice to be back, Innie.
All right, so we have this migration bill. We hear a threat that is going to be toughened. What are the details of this?
Yeah, you're absolutely right. What we're expecting is that the Home Secretary, Suella Braverman, will be able to successfully make amendments to the already highly controversial illegal migration bill, and that is by the British government having powers to legally overthrow any rules that the Strasbourg-based European Court of Human Rights tries to put forward to prevent any illegal deportations of migrants. I believe it's called Rule 39, and this is what prevented last year migrants from taking on that flight to Rwanda. Now, this is highly controversial. You'll remember that this new illegal migration bill first came into the public domain last month, and that's because, of course, we know that Rishi Sunak, the British Prime Minister, and the Conservative government are doing their utmost to stop the illegal crossing of migrants. In 2018, we only had 300 crossings from Calais to Dover. Fast forward to 2022, we had 45,000 crossings last year. That's why at the beginning of the new year, one of the Prime Minister's main pledges was to stop these channel crossings, and they believe that this illegal migration bill will prevent that. It is very contentious, very controversial. One of the reasons why it's so controversial is within that bill, if you are found to have crossed into the United Kingdom illegally, you will be banned from ever returning to Britain again, which sounds to some people as absolutely ridiculous, way too harsh, particularly if you consider, Innie, that so many people that are coming into the UK are fleeing war, they're fleeing persecution, many of them children. So if you come here illegally at 8 years old, you will never be able to return again. That's a huge issue. And I think what's so concerning about this new amendment that's being made into this bill is that it goes even further. One of the reasons why the Home Secretary has made these changes is because those on the hard right of the Conservative Party feel it would be an absolute waste of money, like we saw with the Rwanda, 130 million paid to the Rwandan government, if Strasbourg at the last minute can stop these deportations. So the region is going to be returned to the Commons next week. Again, expect some scandalous statements from the Home Secretary, as well as some pretty vocal critics of the bill. But yes, it does appear as if these changes will be made, which doesn't speak well for anyone trying to get into the UK at the moment.
Yeah, sounds pretty tough there. If you're found to have entered the country illegally, then you can enter for the rest of your life. That's really tough. But anyway, I trust you to stay on the issue and give us updates on that. But let's look at the market now. Is it looking bright or dull?
It's not looking bright. I think we're faring better in the UK than our European competitors, but the FTSE's down. It's down 0.14%. FTSE 100 down to 0.19%. FTSE 250, the domestic market, up slightly by 0.08%. In the currencies market, the British pound is currently trading up on the US dollar by 0.05%, though down on the euro by 0.09% and up on the Japanese yen by 0.02%. If you will permit me, Innie, I do want to bring you a little bit of breaking news, because this does affect the British government and, in essence, the British economy, which is that Dominic Raab, the Deputy Prime Minister, who's currently the Minister of Justice, he is potentially on the verge of being sacked. And now this is significant because if he is sacked after a 5-month probe into bullying allegations, pretty serious bullying allegations. In fact, some people said they wanted to commit suicide after just working with Dominic Raab for about 2 days. If indeed the Prime Minister is forced to sack him, then this will be the third cabinet minister that Prime Minister Rishi Sunak has had to sack in a very short space of time. And Dominic Raab is a very serious ally. Expect investors to move the markets if indeed this does happen, because he is a hardline Brexiteer, a very strong Conservative government minister. But unfortunately, like Gavin Williamson before him, the former Education Secretary, he has been caught up in some very serious allegations. And what will this spell for the Conservative government? I thought I'd just put that in there for you, Innie, because it's a huge story in the UK at the moment.
Yeah, thank you so much, Julian. I appreciate that. And of course, I will get up to date as the story goes. Thank you so much and welcome back. Good to have you.
Thank you, Innie. Talk soon.
All right, let's go to other markets now. Asia-Pacific markets were mixed on Thursday as investors on Wall Street digest more earnings reports from names like Netflix, IBM, and Morgan Stanley, while many of the companies reporting topped analysts' low bar estimates. A lack of forecasts from the major companies also left investors on edge. Look at the numbers now. It's mixed in color. Nikkei 225 is 0.18 in the green at 28,657.57. Shanghai goes the other way at 0.09 in the red, 3,367.03. Hang Seng Index then comes back to the green, 0.19%. Kospi in the red, almost 0.5%, and in Australia, it's marginally down 0.04%, and that's at 7,362.20. Go to the United States now, and there we see that features rose, boosted by an important round of first quarter earnings results that topped Wall Street expectations and suggest that companies are faring better than feared in this tough economic environment. Dow Jones, there, look at the numbers, in the red, 0.42% at 33,890. S&P 500 in the red. NASDAQ also in the red. Red features we see for U.S. stock, and when the markets opens, we'll find out how exactly it ended or how it traded at the close of trade. And we do note, of course, the earnings is one of the major market mover, not just for the U.S. market, but also for neighboring markets like Asia and all. Global oil now prices fell on Thursday as muted U.S. economic data and expectations of interest rate hikes pushed up the U.S. dollar, prompting fear of a stronger dollar hurting global oil demand by making it more expensive. Brent crude futures for June delivery were down 37 cents, that's 0.4%, at $82.76 a barrel. West Texas Intermediate crude for May delivery lost 28 cents, that's 0.35%, to trade at $78.88. U.S. crude stockpile fell by 4.6 million barrels last week as refiners' runs and exports rose, while gasoline inventories jumped unexpectedly on disappointing demand. According to Energy Information Administration, a crude stockpile decline was far steeper than analysts had estimated, which is 1.1 million barrels, and the American Petroleum Institute estimates late on Tuesday of 2.7 million barrels. On the supply side, oil loading from Russia's western ports in April are likely to rise to the highest since 2019. That's above 2.4 million barrels a day. This is in spite of Moscow's pledge to cut output. In the metals market, gold prices inched down on Thursday after hitting a more than 2-week low in the previous session as investors grappled with the likelihood of more interest rate hikes by central banks to contain inflationary pressures. Spot gold was down 0.1% to $1,992.23 per ounce. U.S. gold futures fell 0.2% to $2,004. The dollar index was steady. A stronger dollar increases gold's cost to buyers holding other currencies. Spot silver lost 0.5% at $25.12 per ounce. Platinum was down 0.4% to $1,085.81, and palladium dipped 0.5% to $1,607.49 per ounce. Let's take a break. When we come back, more stories on the other side of Business Incorporated. Do stay with us. Welcome back to Watching Business Incorporated here on Channel Television. Well, with the prevalence and growth of the use of electric vehicles, battery components such as cobalt, lithium, nickel, and copper are becoming more important. Global nickel prices have risen by more than 22% to about $25,000 per ton, and it went from about 21 a year ago. Producers are shifting grounds as we expect, so demand is shifting ground. But let's put more perspective to this with Adeye Adebusi, is an analyst with Financial Derivatives Company, joining us virtually from Victoria Island. Hi, Adeye, good afternoon. Thank you for your time. So we see that things are changing, perspectives are changing. The world is talking more about electric vehicles, and obviously this is putting more pressure on cobalt. So paint the picture for us which way the new trend is.
Global nickel prices, along with other commodities, soared in 2022 due to the Russia-Ukraine war and global supply bottlenecks. As Russia is one of the largest producers of nickel in the world. It rose as high as $48,000 per ton, but they've begun and has since dropped. As global commodity prices have begun to cool. So, however, there's rising demand, as you said, there's rising demand for nickel-based lithium-ion batteries over cobalt-based batteries. And this can be due to a number of factors. Firstly, nickel-based batteries, they have higher energy density, meaning that they can store more energy in smaller spaces. And you can see there's a need for this as the availability of electric vehicle charging stations. They are not as much as you can see for like normal petrol stations. So there's a need for batteries that can store more power for a longer time. Also, these nickel batteries, they weigh less and are smaller. So it gives more space or room in the vehicles for cargo and persons. And aside from nickel, people are going into manganese-based batteries as well because they are less expensive and they're more environment friendly. And consequently, you can see that cobalt prices, they've dropped by 32% alone this year, and trading about 32,000 now in April, especially from a peak in March 2022, which it was selling at around $50,000 per ton. And now these have negative implications on cobalt exporters in Africa like DRC and Zambia.
So when we come to the Nigerian scenario now, on the one hand, we're still talking about refineries and like Dangote refinery. On the other hand, especially for domestic use, we see a lot of shift to green energy, solar energy. How much would you say Nigeria has embraced this new perspective that we see around the world? Electric vehicle is on the one hand, and then this domestic use of solar and the other green forms of energy.
The major challenge in investing in refineries right now is the fact that major economies are setting goals for climate change and renewable energy in the future. One thing to know about the refinery business is that you don't recoup your investments or profits presently. It takes a number of years, up to 10 years to make your profits. And the thing is that the switch to renewable energy and electric vehicles, of course, is a threat to all the oil business because it could weigh down prices. But then, apart from that, the switch to electric vehicles is not expected to be universal in the near term. It is more of a long-term prospect. So, and especially in developing countries where these vehicles are not expected to be rampant anytime soon because the penetration is really low here. The oil refinery business still remains viable for us, especially as we need fuel to power our houses, our homes, our cars, as the ongoing power problems we have. So, and also we need to understand the oil business is not only petrol. The byproducts include kerosene and aviation fuel. So consequently, over in the long term, the internal rate of returns on the oil refining business, of course, will be negatively impacted. So instead of recouping your profits in 10 years, it will take as long as 20 to 25 years. So, but the oil business will still remain viable in the near term.
Yeah, and that's what a lot of analysts have said, that we'll still be in the oil business for a while. But thank you so much, Adeya Adegbusi, analyst, financial derivatives company. Thank you for your time this afternoon.
Thank you for having me.
All right, let's move to Zimbabwe. Now, Zimbabwe expects to harvest 2.3 million tons of the staple maize grain this year, and that's a 58% jump from the previous season, driven by favorable rains. According to a statement by Cabinet, the southern African country of around 16 million people has struggled to feed itself since former President Robert Mugabe led the seizure of farms owned by white people at the start of the millennia to resettle landless black people. Zimbabwe has also endured frequent droughts over the last years as a result of climate change. Zimbabwe expects to harvest 280,996 tons of drought-resistant grains, such as sorghum and millet, a 45% increase on the previous session, as the country seeks to limit the impact of climate change on household food security. The total cereal production is 2.6 million tons against a national cereal requirement of 1.8 million tons for human consumption and 450,000 tons for livestock, leaving a surplus for the country. The East African Community Secretariat has commenced the process of digitizing its Common External Tariff, CET. The program, being implemented with the support of the World Customs Organization, WCO, is meant to enhance the private sector's participation in international trade. Through this digitization of the CETs, the business community, exporters and importers will have access to trade information from the private sector in international trade. The platform, which is currently under development in partnership with Global Trade Solution, will enable seamless migration of the EAC during the transition of the harmonized system. It will provide information on the administration and management of the duty remission scheme, the production of information, and publication of other measures affecting the implementation of the CET. The platform will also include management of preferential tariff treatment of originating goods. In Kenya, listed power producer Kenya Electricity Generating Company, KENGEN, is eyeing a windfall from a planned sale of 287,416 certified emission reduction credits, CERS. The bulk of it is Olkari 1 geothermal power project. The CER is equivalent to 1/3 of carbon dioxide, and they are part of emission reduction efforts under the Kyoto Protocol. KENGEN said it's been issued with a total of about 4.7 million CERS, with its 6 projects registered under the Kyoto Protocol's Clean Development Mechanism, with some potential reduction emissions of 1.5 million of carbon equivalent every year. Going by global market estimate, KENGEN could tap a tidy sum from the sale of the carbon credit after prices surged significantly on increased energy prices due to the war going on in Ukraine. And still from Kenya, we do see that there's been construction costs shot up by 7.1% last year, owing to a sharp rise in the prices of key inputs such as cement, steel, bitumen, and fuel, which slowed down the steep growth the sector enjoyed in 2021. Data from the Kenya National Bureau of Statistics shows the construction cost index, which tracks the cost of construction inputs, rose to 113.65% in the fourth quarter of 2022, and that's up from 106.12% in the final quarter of 2021. It's the fastest annual growth in construction costs since KNBS rebased the index in 2019. In 2020, the cost of construction increased by 2.59%, and supply issues due to COVID-19 restrictions that shut down global supply chains. So we close the program in Kenya today. Thank you so much for being a part of it. I'm John McQuarrie. Enjoy the rest of your day.